All right. Good morning, everybody. We're still on hurry up and wait mode with Powell going to Capitol Hill twice this week. And it just disrupts the whole morning. So if you liked how trading went yesterday, then you're going to love this week because it's going to be more of the same. We do have ISM services and we get rate decision out of Europe on Thursday. So there's just a lot packed in to what the market has to digest. So Hong Kong down significantly this morning, 2.82%. Everything China related, the Alibaba, Baidu, JD, PDD, all of those, they're all going to take a hit. Behind that, we have the NASDAQ down 0.5%, small caps right behind that. Then the S&P, and finally the Dow down the least at less than 0.25%. Japan is up just slightly, not enough to really even turn the tables. So as you can see, factory orders, ISM services, and then we're going to get some Fed speakers. Not a lot to it, right? Not at the moment. We can see the impact projection or what they anticipate the impact is going to be due to previous examples of when we had this econ, what was the outcome. This is a volatility gauge. So the more frequently ISM services has been volatile, the brighter the color. It goes from a light gold to a dark red. We're expected to come in a little lighter than before, 53.4, and this time it's going to be 53. So we'll see how the market likes this. There was some data out on AMD. They got denied for a more simplistic chip that they were hoping to sell to China, but it's not simplistic enough. So they got denied on that. They're going to have to revamp it yet again. Apple is down as well. Data coming out showing that they've had a huge hit to iPhone sales and that resellers had actually offered price cuts, significant price cuts. And that's unheard of for Apple phones. So taking a hit on that side, Apple's big enough to move the market. Everybody's expecting Powell to try to tamp down market enthusiasm, but there's a difference between prepared remarks when Powell is talking and then when he's just chipping his teeth answering questions. He can stay pretty hawkish when he's following script, but when he gets off script and starts talking on his own, he always sounds like a dove. And then markets get all confused and they don't know who they should be cheering. So we'll see how much latitude he's given to step away from prepared remarks. Neither one of these Fed events with bar should come to much. Panel discussions, roundtable listening session, these shouldn't be that big of a deal. Still, when we got Fed speakers talking, we want to watch the clock, watch the news. All right, so we're starting the week with a little bit of a pullback. Looking at the week, so we've been having this kind of fits. get a nice run up, a little bit of digestion, a new run up, a little bit of digestion. But the distance between each run up is getting smaller and smaller, and that also makes sense. Remember, the week isn't over, so looking at a weekly candle midweek can be misleading, to say the least. We're still holding within the proper zone, though, right? If we were to cut this in half and look at the half back level, we haven't even tested it, let alone broke below it. So 5,100, if you want a nice round number, is the number that we need to stay above for this half back bias. And really, I mean, look, we can close below this level, we would still be in a bullish market, right? We would still have a bullish backdrop, bullish analysis. Cutting through that line doesn't take away from any of that. But closing below that line starts the question of, is this starting to digest a little bit? And are we going to get any sort of a pullback at all? Because we can close red like we did back here and still really not give anything away. But even back here, while we got below the half back, we managed to rally back up and close above it on the week. So everything's still looking fine. No real warnings for a bigger significant reversal. If we measure the last big day, which was March 1st, that's our door candle, day one open range. Then you can see that we tested the half back, 51.19 and a tick. Just forget that tick. In fact, you could probably round it up to 51.20 and be good anyways, right? Nice round number. No reason to stress on it. And again, this isn't a line that we have to stay above. We can wick below it. We can close below it. Wouldn't be that big of a deal if we actually came back down and tested that 10 again. But you can see how everything is starting to stall out again. We had a nice digestion period back here. We legged up into a whole new zone and again, digested it. We didn't get much of a leg up and we're already digesting it again. Market's really struggling with these high levels. If we do break that 51.19, then the 10 period moving average is the target, right? 50.94, call it 5,100 just for a nice round number. So a 20-point play if we can break that low. I'd get nervous right on the open of this candle, and that's really close to the 20 line anyways, or the roundy. 5101, that's close enough to 5,100. I would look for that to be the target. And then if we overshoot, maybe we get a couple more points and we can tag the bottom of that candle. The call wall is still at 5,200. Volatility trigger is underneath the weekly pivot point, which we continue to hold above just barely. We did get an MDP yesterday. It's a missed daily pivot, but we opened underneath today's pivot, and we also have an MDP today. Now, today's missed daily pivot doesn't count until the end of the day, just like yesterday's didn't count until today. Yesterday's is already negated since we opened underneath the pivot point this morning. So that yesterday's was just a scratch. We are still holding against the weekly pivot point on the upside, kind of expecting that to hold. We can dip down and wick below it like we did, say, last week back here. So we can interact with that level. It's not too big of a deal, but we need to get back above it, right? If we're going to maintain this posture. That is the 3-week moving average and the 10-day zero gamma all the way down at 50.70. And if we get outside of the previous week's low, continue this look to the downside, we've got the 10-week moving average and so much farther below that, 48.31 cog line and 48.11 put wall. That put wall is so far away. It's not going to do us any good. It's not going to help us out. There's nothing there of any sort of assistance or anything. It's just like, thanks for nothing, right? Volume is fine. It's in line. We don't really have anything on the volume side to be concerned with. They're not hedging this morning. And, you know, the base case was that we were going to hold the line. We weren't really going to get anything, and we're waiting on PAL. So it's one of those weeks where it's just going to be a lot of reversals and testing resistance, a lot of stop hunting. And I said it at the open, but I'll say it again. If you liked that kind of trading that we had yesterday, then you're going to like this week, because that's what it's going to look like a lot. So we can make big moves while still really not going anywhere. Yesterday was a perfect example of that. We had some good moves in the later part of the day, big moves in both directions. And at the end of it all, we weren't any better off than when we started the day. Now that we're inside day breakout, we need to keep it. So if we're going to continue this move to the downside, this bearish posture, let's get below the weekly pivot point and start challenging this volatility trigger and that 5,100 level. We're not looking for a sell-off into oblivion, right? This isn't the idea here. But if we can get through the weekly pivot point at the very least, we can get to the ADR half. It's 51.11. And if we get to the ADR half early enough, then we can take the other side and start looking for an upside ADR level. NEO is reporting this morning. That's one of the China ADRs. And Wednesday morning, JD is going to be reporting it's one of those China ADRs. $10-day, 30-minute volume profile. We're going to lose more of this volume and along the lows. And if we don't break this 51.50, then we're going to get a much more compressed structure here. Something's a little off. So let's. Yeah. All right. So once we do leave all of this behind, if we don't break below 50.50, then we're going to have a very tight range around 100 points from 50.50 to 51.50, basically. That's a pretty tight zone for a 10-day ES chart. So we carried forward that point control yesterday. It was no longer a VPOC, but it was still a POC. And you can see how the market responded to that zone again before it was finally taken out, right? So it was worth putting it on the chart as it provided some context later in the day. I guess this kind of highlights what the books always talk about when it comes to these point of control and volume profiles. If you don't have enough pivot points and you want to add something to your day, bring up the volume profile from yesterday and carry forward the point of control and the value area high and the value area low. I don't need more pivot points, so I generally don't do that. Instead, I just keep track of the ones that hasn't been hit yet. All right, so we've got one here from yesterday, and price has not hit it. So we'll carry this one forward until price comes up there and hits it. some of these can last for quite a while, but one thing to keep in mind is when they were made and when the contract ends, right? We've got some of these that have been around for a long time, and once the contract ends, it's really hard to make any sort of an argument for unfinished business at that point, right? That way, it's not like equities. If you mark something off in equities and 3 years later you get back there, you could still make an argument that it has some validity to it, but you didn't base that on something that was going to expire, right? Those traders who made that point of control didn't have to roll out or change out their position. So when it comes to the futures, at some point, I think these date themselves to where they're just not, that it just don't have any value anymore. Still, we do have a new one based on yesterday's price action. That'll work. All right, we were a 0.5% above the 10-day. So far, this range that we're working on continues to hold. Is kind of an impressive range, really. When you think about how chaotic things generally are in this space, and we're holding this zone really nice. You can catch the replay too, Cliff. I'll show you where it's at so you can get it. The reason I bring up this range is directly related to the idea of how volatile the market has been since COVID. And I get it. If you look at volatility indicators, it's down, right? I mean, I think the VIX is close to getting below $13. So, quote, volatility is down. But volatility is a nerd word for movement, right? And how far the market moves on a day-to-day basis is volatility. The S&P, the ES, in the RTH trading session between 9:30 and 4 o'clock had an average daily move of 8 to 15 points total. That was the average move on the day, 8 to 15 points. If you were really lucky, it was a 20-point day. So you can imagine, right, how difficult it is to trade when in the entire trading session, you're really lucky to see 12, 15 points total for the whole day. That made the weekly expected move a lot smaller because how far we were moving on a week-to-week basis was a lot less. And the distance that we would get from the 10 was a lot less on average, consistently. COVID's a long time past, and volatility has really dropped down when we're looking at things like the VIX. But our day-to-day price swings, looking at something as simple as the ADR, still shows a really wide daily travel, right? From the entire 24-hour trading day, but even just within our own 9:30 to 4 RTH session. It's still big days. This gets my attention here with this small range, this distance away from 10 consistently, as another example of the lessening volatility out there, that our trading days are going to continue to get smaller and smaller. And that especially you newer traders are going to have to find more and more ways to get more for less, right? Instead of those big moves where, we catch V bottom days and can run the ES 30 to 50 points, having to take much smaller trades and be in them longer. It's a whole different trading style, that's for sure. Which is why back then I traded the NASDAQ a heck of a lot more than I have after COVID. The NASDAQ just moves farther. Even back then it moved farther. So it's something we want to keep our eye on, this distance from 10. Way back here when we only had a few data points, it wasn't much. The second month, it really started to stand out a little bit. Now we're getting into our third month and it's starting to become a bit of a theme. So we just want to keep our eye on it. It's a good thing that the markets are being less volatile all around. It's just going to change up our trading style. No, that's a fair question. I don't show it, right? So if you're using the levels here, these volatility triggers and, zero gamma and all that, and you want to know what that means, one, you can read the founder's notes, because it seems like every week I read something out of those founder's notes that explains more about these tools. And that's really nice. The other thing would be hit YouTube. They want to sell you a product, right? Spot Gamma is the creator of these levels. They want to sell you a product, and they know that if you're going to buy their product, you have to see examples of it or understand it. And they have it all over YouTube. So you can go to YouTube and hit Spot Gamma and type in, call wall, put wall, volatility trigger, whatever, in your search engine on YouTube and learn more about these levels. And it's not just for Spot Gamma either, right? Once you know how these levels work, it's the same on all the other places out there that have those levels. With the hurry up and wait that we have this week, there's not a lot of expectation for, a dominance on one side or the other. Even the negativity out there isn't negative enough to really take us down a long ways. We got to get through PAL. We got to get through the data coming out of Europe. There are pockets that continue to do good. Right now, semiconductors are a little weak. China ADRs are definitely weak. And the things that are up, a little bit that they are, bonds and precious metals. Not a lot to it since we're still on wait. Still got to get through PAL. But 5,100 is the level that I'm focused on. If we break 5,120, and then we will reassess at that point, but we could overshoot down into 50.89. I wouldn't expect any help out of the MAG 7, any of those. I don't think we're really going to get much help out of that. We don't even have pot stocks or anything like that. Nothing else, really. Short and sweet. Yeah, watch the clock, watch the flows. Be careful. I'll see you guys tomorrow.